We all know the value of finding a diamond in the rough. Today, we're going to talk about the real estate investment equivalent of that diamond in the rough. I want to highlight opportunity zones. Created as part of the Trump tax cuts in 2017, opportunity zones are 8,700 geographic tax havens in all 50 states. The zones are designated to attract new real estate investment capital to improve and revitalize distressed areas. Some of these areas are a bit rough, but you will find many great areas where lawmakers want to encourage growth. Significant tax incentives are offered to real estate investors to entice fresh capital into projects in these areas. If you are engaged in new real estate investment activities where significant dollars are going to be deployed for the building or improvement of the property, visit the interactive map at HUD.gov to see if your proposed property is eligible for these tax incentives we are talking about today. Let's highlight the tax planning priorities this tip hits. Opportunity zones are a double hitter. We are excluding income from taxation, which is a major win, and we can also defer the payment of taxes for about 5 years. Let's break that tax incentive down just a bit. The big headliner here is the elimination of tax on future gains of the property. When you invest in a property inside an opportunity zone and you hold the property for at least 10 years, you are eligible to adjust the basis of your property to its fair value on the date you dispose of it. That's huge. That means you can eliminate the tax on any profits from your real estate investment when it has been owned for at least 10 years. Unlike a 1031 exchange where you are simply kicking the tax can down the road but will eventually have to pay the tax on the property, opportunity zones are rewarding patient capital by allowing you to eliminate the tax on the gains of your property. A second incentive also focused on the elimination of tax due when you deploy dollars from the profitable sale of other real estate, stock, or a small business. You can eliminate 10 to 15% of the tax on the gains of assets sold when you deploy those gain dollars into an opportunity zone project. Worth noting here, you can choose to limit your investment in a zone to only the gain dollars from the recent asset sale while taking some of the chips off the table. The final tax benefit is focused on tax deferral. When you sell a profitable capital asset and deploy some or all of your sale proceeds into a zone project, you can delay the payment of your tax on the recent sale until the spring of 2027. The tax due in 2027 would get a 10% haircut for choosing to deploy those dollars into a qualified project in a zone. Let me hit a few pitfalls in aiming for these tax incentives and then I'll let you go. First, the dollars need to go into a qualified opportunity fund, not just a property inside a designated zone. A qualified opportunity fund is an LLC that is applied to the IRS for specific tax preferences associated with a zone. You can set up your own fund for a private project you are personally pursuing. Call us to talk about that option in more detail. Or you can invest in a QOF already recognized as a QOF with the IRS. Second, if you are acquiring an existing building inside a zone, the tax incentives associated with a QOF require that at least 50% of all the costs on the property are for improvements to the property within the first 30 months of ownership. Said another way, your improvements need to be equal to or greater than the original cost of the property. Lastly, the acquisition of a business that operates inside a zone can make the purchase eligible for these same tax incentives that are focused on patient, long-term capital. It is often said that opportunity zones are like 1031s on steroids, and now you can see why. If you're exploring new investments in an area designated on the HUD Opportunity Zone maps, give us a call to talk more about the specifics. We can make sure that you are set up for success.